right, welcome back, guys, to another great episode of REI Hot Seat.
Yes.
We're here today. We're going to dive into a deal review.
And hopefully the set looks even better.
Our
keeps
set
improving.
just gets better every
Keeps
time.
improving. Yes, we have a man with a plan behind the screen, so
Yeah,
he's
that's
helping.
it.
So
Love it. So, Dave, what do we have today? What are we doing?
we're going to St Catharines.
Okay.
Okay, this is an on-market deal. They just reduced the price, so it was 2.5 million. It's now 2.4.
Okay.
The reason I chose it is a lot of interesting components to it, but this is effectively fully renovated, all one beds, pretty strong rent. So we're going to look at why it hasn't sold, why I think it hasn't sold.
Got it.
Because it's not the building.
Okay.
There's nothing wrong with the building. The building's great. New windows, units are renoed.
Love it.
It doesn't have a flat roof. Love that.
Oh, okay.
Yeah. It's a nice property.
Purpose built, not flat roof, or did they do the old
Purpose-built.
peaked roof after the
Peaked
fact?
roof after the fact.
Yeah, nice.
Beautiful. So we're going to do that. We're going to talk about where we think it needs to land.
Okay.
I'm really curious to see your take.
Yeah.
And then I also ran this with the old benchmarks, CMHC benchmarks,
Got it.
because I'd like to see how they differ.
Yeah.
Because we were having
So
this.
do we have old and new benchmarks, and we can do a little compare and contrast?
Yeah,
Okay, perfect.
and I'm going to put you on the spot and let you guess how much of a difference it is. So I was having this conversation with a client who, his comment was, man, I thought it was going to make a much bigger impact.
Right.
I'm thinking, like, does it make a big impact or not? So
Yeah.
we'll look.
It's interesting, right? Like I've been underwriting everything now with the new benchmark. But to your point, I have some deals that were originally run with the old, then we ran them with the new.
Yeah.
In some cases, I actually have seen quite an impact. In other cases, not so much, right? But I think it's just the compounding effect of inflated cap rates,
Yes.
plus the new CMHC underwriting, plus this, plus that, and then you're sitting there with
And,
that
and
new
I'm on
value.
the buy side, right? So it's like I'm already building in a whole bunch of
Yeah.
sand into the deal.
Well,
So
this
it's
is all
like,
fun stuff for you. For me,
it's
I
all
see it. I
great.
get all
Right.
stressed
You're
out,
stressing
right?
I'm going, well, I guess I'm lowering my purchase price. But important that people realize the benchmarks doesn't mean it's going to actually change your cash flow,
Yes.
right? It's just what they use as the inputs to derive how much of a loan they're going to get.
Yeah, we always talk about this where we look at, we have the benchmarks, and then we have actual, right? And lately, I know a lot of people are just using the benchmarks as the actual. It's the simplest way to kind of standardize the market.
Yeah.
But every once in a while, I like to show people, hey, listen, like here's your benchmarks, and then here's the actual landscaping bill, utility bills, and we go through and show everybody that as well, which makes quite a big difference sometimes, right? If you're looking at it, and just depending on the asset,
Yes.
right? I find, not to go down too much of a tangent, but I find if you look at the concrete build benchmarks for CMHC, they are quite a bit higher than the wood frame build benchmarks, and I find that's where the bigger discrepancy, maybe not discrepancy, but that's where the bigger delta comes from.
That makes sense.
And I guess the rationale behind it, I don't know if you know it or not, but why is the concrete more expensive?
I don't know.
Right, the R&M and the salaries, et cetera, right? I can only imagine that it's when something does go wrong with concrete,
It's very
it
expensive.
costs more.
Yeah. But gun to my head, I'm like, I feel like it would be less expensive. But I hear you.
That's my thought.
Yeah. So it's a good point when you look at the concrete, which would typically be the larger, a little bit more expensive deals in general. Those is actually where you start to see that deviation a little bit more. I agree. And to go back to this deal, this is an 11 unit in the $2.5 million range.
Yeah.
So without giving you any indication of if there's a difference, but it gravitates more towards the smaller size of deals,
Right.
so perhaps not quite so impactful. So I'll give you a kind of the rundown here. Most of the rents are at market or pretty close. Okay, so we're looking at, we've got about $1,500 a month as what we figure is market. Okay, for one bed units this size in St. Catharines, this area of St. Catharines. The average rent, like most of them are right at $1,450. There's one, the lowest rent is $1,018. So strong rent.
Okay.
So pretty close. Okay.
So is it safe to assume everything was recently renovated there?
Yeah.
Okay.
Yeah. So think of it fully renoed, for the viewers, I'll show some photos for those that are watching. It's nice building. Got a lot of even the mechanicals are clean. So every unit is renovated to different standards based on the years they were done. So for example, you'll probably remember that. That was kind of like COVID, pre-COVID times, right? That was really in. And you get to kind of, these are like the, all nicely renovated.
Snapshot through time.
Through time. Like this is a little bit more
Yeah.
today's date, I guess you might say, right? That's, again, it is renoed. It's just an older style. So in any event, running the numbers, taking a look. There's no parking income. There's just laundry income as well for additional.
Got it.
So at 2.5 was the original list. Don't worry about talking about that. I ran this for now at 2.2. Okay. So that's 200 a door. That's a 5.7 cap rate. If we go to CMHC, debatable on where we are on the rate. I used 4.25. It is moving reasonably well, but we'll stick with 4.25 right now. We could get to a 1.3 debt cover. This is the new benchmarks, meaning we could do, and I don't mean to get in the weeds, but we could do a 5 or a 10-year CMHC debt. Our cash on cash with mortgage pay down would be just shy of 11%. Okay. So
that sounds like a decent deal.
I like it. It's just right now, the only deals that are selling, and you know this better than I do, are the ones that we don't like, we love.
Yeah.
So my brain says I can sell this deal. That's a good deal.
Yeah.
It's not, I don't know that it's going to sell there. I really don't.
It's almost like, where do you like it? 2.2. Okay, great.
Yeah.
Now, where do you feel uncomfortable? Right? It's like, what? It's the offers that are getting done are the offers where I have to call the sellers and be like,
Yes, you got to be.
Hey, I have an offer for you.
Yeah, it is almost an indication of the market. Like there's so much going on, but the deals that are being done on the buy side, we're going, damn, that was a good deal.
Yes.
Right, and the sellers are going, that was a bit painful, but not outrageous.
Yeah.
Right. So where do I really like it? Let's talk about that. So if you were to kind of put a cap rate on this, where Jake really likes it, where would you go without being crazy?
Where in St Catharines?
By the pizza.
Location wise. Okay, by the pizza.
Yeah, that's a reference to the old one. Yeah. So this is on Ottawa Street. You know where that is?
Yep.
Okay.
Yep.
And you do know St. Catharines well.
I would probably like to see it somewhere around high 5s, low 6s. Call it a 5.75. Being a turnkey, the challenge I see is all 1-beds. Right? Just like all bachelors, just like all 2-beds, there's always going to be a little bit of challenge. It's better than all bachelors, don't get me wrong.
Yeah.
But having all of one style of unit, a little bit more challenging. Location's okay.
Yeah.
So, I'd probably be 5.75.
Yeah, you and I think similar.
Right?
I was 5.75, really love it at a 6.
Yes.
Right? 5.5 is good. Yeah. 5.75 probably makes the most sense.
And where do you feel uncomfortable presenting it? 6.25?
Right? Like how low can I go without, not getting signed back? And here's the other way to look at it, I think is important. If we ended up buying this for 2.4 million, which is list, okay? There is still a little bit of lift in every unit. So, call it $100. One of the units is 500. So there's still some lift. You buy it for 2.4. If I put a 5.5 cap on the exit, we're 2.6 million, meaning there's absolutely no additional value. No. And I think that's part of the story of these fully turnkey.
Yeah.
There was a time not long ago where these turnkeys were really selling.
Flying off the shelves.
Flying off the shelves.
So I think, my rationale to it, moved the lightsaber. Yeah. My rationale to it is it's a correlation between buyer profile, building size, and stabilization. Right, so it's kind of 3 different levers, as you like to put.
Yeah.
If you're looking at a institutional company, public REIT, etc., whatever, one of the big guys, I still see the turnkey assets moving quite well. Right, everybody likes a little bit of lift. Everybody likes the perfect deal, which is no major capex, but there's still a little bit of room in the rents, right? We're still getting it
Those
for
are
a
the
6 and
best,
something
yeah.
cap rate. But I think the challenge is when you get down to these smaller units, who's your buyer profile? And I think that's the biggest challenge we're seeing in the market right now. An 11 unit for $2.5 million, $2.2 million, it's going to be a small to medium size investor, right? This is not. It could be an institutional play, but unlikely that an institution is going to come in and buy 11 units, unless they have another 100 units in that location.
And even then,
but even that, right? So when you're looking at that, you're going, okay, small to medium size investors, what do they need to make sure they're doing? Well, they need to purchase well, and they usually need to recapture some of their capital within 5 years.
Great point.
Right. After all those intake calls we've done over the years,
That's a great point.
That's the same story I get time and time again, right? Which is I don't have a huge investor pool. I don't have $1 million, $2 million, $3 million of raising a year, right? I have a refinance I did out of my condo, personal property, another building, right? I built up a nice little portfolio, have some cash, good year at work, whatever it is. These are the funds that I'm buying with, and this is it. So how do I recapture my capital in a reasonable timeline? And even 5 years might be too long for some people on a building of that size. They might want to see it back in 2 years. Where this is more of a nice turnkey buy and hold type asset. That's where I see the big discrepancy in the market right now. Right.
That is a great point.
Now, if we're looking at a 50 unit, an 80 unit turnkey similar asset with good market rents, a larger company will come in and say, great, this is just a nice thing to add to the portfolio, decent location, it's all turnkey. It's going to give us an 11% return on our money. Well, we're paying our investors 8% on their money, so great. There's a little bit of a spread. There's the delta. We're happy with it.
It's a beautiful breakdown.
And we don't need to we can keep that building for 50 years.
Because they have the 100-year time horizon versus, an individual investor.
Instead of running it at a 5-year plan, they're going to look at a 10, 20, 30-year plan and say, great, in 10 years, I can recapture my capital out of natural appreciation in the market.
Great breakdown.
And I've had this conversation with many sellers, right? Because they're saying, why is my turnkey beautiful property that I spent so much money renovating not selling for where I think it should be selling? And that's the story.
It's a great point. So what's interesting is where does this become compelling enough, right? So if you pull this back to, even if we said 2-1, which is a far cry from list at this point, so probably undoable. Actually, let's do 1.25. That'd be a better place for a discussion. That pulls us to a 5.85 cap rate. Okay, we're sub 200 a door. We're 195, and we are 11.5% cash on cash. You need $400,000 to do the deal. And again, that cash on cash is based on the new CMHC benchmarks, which again, to a turnkey building, we're almost certainly overestimating the expenses. So our true cash on cash is likely going to be higher.
You could be 12, 13% on this thing, right?
Yeah. So. And if we pull that to 2-1, because again, I think the exercise here was where do we really, really like it? That pulls us just shy of a 6% cap rate. Okay. We are almost 12.5% cash on cash, $400,000. You're at a 1.36 debt cover. You're cash flowing $30,000 a year while, building in all the, we have $15,000 a year for maintenance and labor, CapEx and appliances.
Right? And that's assuming current rents.
With no change at all. So
devil's advocate for a second, right? I'm sitting here and I'm going, because I'm going through a couple of these myself right now, where I have these listings and it's like, man, I can't recommend a price reduction. It's worth what you're asking. But the buyer is not out there. Who is buying this building, right? Because I'm sitting there, I'm like, 11% cash on cash, 12% cash on cash. It's fantastic. But if it's a one and done, is this going to be the only building you own? If you're not tapping into another $400,000 in the next 5 years,
what are you doing?
Yeah. And buying one and done might not be a good strategy. You tell me. I might be wrong on that.
It sort of depends. I think your point is well taken, which is the vast majority of people are true investors, meaning they understand if I can recycle my capital, I can do this and we can make a much better return. If you look and compare to, the general stock market and you look at something like this, which is arguably we're at a low point not even arguably, actually, we're at a low point in the market, maybe not the lowest, who knows. We aren't building in 2% annual increases. We aren't talking about appreciation. That conversation is dead right now, which is one of the key factors to making you successful in real estate. So,
Principal pay down.
Principal pay down. So this has mortgage pay down in the cash on cash for this one.
So it's not technically a cash on cash. It's actually more of a
Cash
ROI.
on cash with mortgage pay down.
Right.
Yeah.
We're excluding appreciation because we feel right now things are stagnant, maybe even going the other direction.
Yeah.
So let's call it ROI rather than cash on cash, because
sure.
your true cash on cash then might actually be something closer to what, 10%?
7.2.
Okay, perfect. Right.
So if we go, because we're getting about 21 grand mortgage pay down on average for every year for 10 years. So I think when we look at this, to your point, because you and I have had many discussions as the buy side, the sell side, you're saying, where does this deal need to be for you to bring me somebody? And it's kind of like a head scratcher.
There's some of those deals out there right now that are they just won't sell. And it's like so the buyer profile for this, right?
Yes.
We'll wrap up with this, right? We'll talk buyer profile. Somebody that's local, right?
Yes.
Then a one and done kind of makes sense, right? It's Bob, he lives around the corner, he's got a house, he's got some money he pulled out of his house, wants to do something with it. Doesn't want to be in the stock market because he likes real estate. He can cut the grass, he can manage the building, it's around the corner, it's going to be less of a headache than, call it, a value add building, right? That might be a good buyer profile for it.
It's a good avatar.
Or somebody that is, again, that more medium-sized investor who does have capital regeneration there somehow through his income, through investor capital, whatever it may be. They already own 4 buildings in the area. They want to just add this to the portfolio.
I would add one more avatar to this, which
it.
would be a high income earner.
Yep.
So, if we're talking, think professional, right? They're able to accumulate capital reasonably quickly. They're looking for options and ways to invest. This isn't the only investment they have. It could be their first, but they're saying, hey, look, I want to branch out. I want to diversify. And they're okay, because this isn't a headache of a building. You're going to buy this and probably, look, everything requires work, but these would be the ones after a little while you sometimes forget in a conversation that you own it.
Yeah.
Because it's been running smooth.
Which are great buildings, right? Those are what you want. So I guess kind of final comments on it. Do you feel that the last profile you just mentioned, are those buyers out there right now? Are you seeing them?
Yeah, we've got a few right now that are quite active, and the fun part for them is like where we have options and where are you most excited. So to kind of circle and bow this thing up is, like you said, somewhere close that feels comfortable because it's your first building, and where do we get excited? Because it isn't at a 5.5 cap. So the question then becomes, let's offer a 6 or let's offer 6 1/4, and you know what? Let's get told to kick rocks.
And we'll see where we land.
Let's see where we land, and then let's go do this to 3 other buildings at the same time and see which one we get.
Because I guess my final comment on it, a building like this, you're gonna, and I know you've probably done this already, but I'm just going to verbalize it, which is, if rental rates continue to decline and tax rates continue to increase, you need a number where you're safe to feel comfortable knowing that, hey, if this building operates at 5 to 10% less than what it's operating today, it's not going to stress me out. I'm still going to be able to sleep. 100%. It's still a very comfortable deal for me, and that's where I'll leave that.
That's why we like to see the 1.3s pluses debt covers. So.
But it's a beautiful building. Don't get me wrong. I'm just playing devil's advocate here.
No,
I'm not saying don't buy it.
It's a good point. We take the market rent and we're combing it. So market rent today, which is already down substantially, and we take that number and we comb it backwards from there, and we go. We'll even see right now, this doesn't have it, but market rent on a 1 bed, and it'll be $19.50. That's what actually they're getting, and then you'll see our stabilized rent actually goes down.
Correct.
And that shocks people, but it's important. So,
but that's the reality right now. What we're seeing.
People leave, or people come to you. You have it, right? Well, I've had it, which is our tenants come to us and say, "Hey, like living here, but turns out I can actually move across the street. So do you want me to stay and give me a $200 rent decrease?" Oh, sure.
It's interesting
Happy
times.
to keep you. So this deal is still available. It'll be interesting. We'll track it. We'll see where it lands price wise. But yeah, what do people do, Jake? What's the next step?
Love it. Yeah. Guys, if you like a building like this or anything else that we've talked about on this show, like, subscribe, go to the link below. You can sign up to the insider list, get direct access to these buildings and other buildings like this, off-market deals, private deals, just some of the stuff that doesn't hit MLS. So sign up. It's important. You get access to it. Always happy to have a phone call. We can jump on, kind of do an intake call with anybody if they request it. And click the bell if you want to get notifications that these episodes are coming out.
Yeah. And if you want to sell your building or if you want to get a valuation on what that is, even if you don't want to sell it, same thing. Reach out.
Thanks, guys.